when I look out my window.
Hello traders, Gary Wagner with Gold Forecast here, approximately 9:30 a.m. in Honolulu, Hawaii, Tuesday the 17th day of May, and this is the Daily Report. We do have gold trading lower this morning, currently trading off about $8 to $8.50 lower, 1481. That's coming off a low of 1471. Traders, over the last few days, you know that I have been looking at the possibility, and it was my belief that it was likely that rather than having a standard ABC correction, what we were looking at was a basic, what's called a triangle correction or a pennant formation. Now, when we got this lower low today, that absolutely negates that theory. There's no doubt right now in terms of what I was looking at, a five-leg position, that would be correct. Because if that is the case, you will not typically get a lower low. That would negate it. And in today's report, I want to talk to you about what I believe we are witnessing in the market. And to let you know ahead of time, I personally don't believe that the sky is falling in. I don't think that we have a scenario right now where we've had a fundamental shift and a fundamental change overall in the direction of gold. What we do have is a correction that I believe is deeper than personally I had anticipated and that many other traders had anticipated. But at the same time, we are going to take a step back, take a breath, so to speak, and take a look at this market in a logical, concrete way to ascertain where we think this market will head, short term, interim, and long term, all here on today's report. Traders, the first thing that I want to look at to take an objective view of the market is to compress in time and look at our master chart in terms of the detail and the wave count itself. I absolutely believe that there is no doubt that we are currently in a wave 4 correction. I also believe that following a wave 4 correction comes a wave 5 impulse phase. Now, based under the assumption that we are in a corrective phase, we are in a wave 4 stage that will be followed by a wave 5 rally, we need to try to make sense or determine what are possible likely scenarios for how this correction will play out. There are certain things that at this point we can say with a degree of certainty. As this market came up, we can say that we have had our first wave A. That wave has concluded. We can also say that we have received our B wave bounce up. Falls in line in terms of the amount of the move. It was just above 50%, so it falls in line with traditional charting techniques vis-a-vis Elliott wave. Now, that being said, there are two possibilities. We are either A, in our corrective wave number C, and that C wave could either truncate, which is where it's at now. It could go flat, meaning it could have an equal low to what we saw before. Or if it is a standard C correction, it could actually trade below this. Now, it cannot trade far below this because, mind you, one of our unbreakable or immutable tenets within the marketplace itself is it cannot trade into the range of this corrective wave 2. 2 and 4 cannot touch, so to speak. So that the bottom line is, if this is going to fall within traditional Elliott wave forecasting techniques, regardless of how the market trades here, it cannot trade much lower, or it cannot trade, below this 1440. Traders, we are looking at a weekly chart in which we're going to take a long-term view and ascertain, as we saw these rallies, what types of corrections we have seen in the past, and compare that to the type of rally that we're witnessing right now. First, we want to go back in time. The first set of retracement areas that I have is when the market traded. This is back in 09, April of 09, and the market moves from roughly $850 and hits a major high up here at 1227. You can see that here. Now, the correction that it had itself was roughly a 50% correction of that overall move. You can see that the low that this market hit as it corrected was 1045, and you can see that the 50% retracement area was 1038. So that's an extreme correction, but this is a 50% correction in the marketplace. Now, the next place that we look at is the move from 1045 up to 1264. That's this area right in here. And when you look at that area, again, we got pretty close to a 50% retracement on the market. So that you see that the low here, 1151 and 1154, is that 50% retracement area. The next level that we look at, of course, is this move from 1151 up to 1428. And this time when it corrected not quite to the 50% level. I've got both of these bands in here. I've got our low at 1308 right here. This was the low that we had at 1308. And as you can see, that came in between because the 38% level was 1322, and then 1290 was a 50% retracement, so it dipped below. But here is what I find interesting. This is on a weekly, and we're going to pull it to a daily in a second. On a closing basis, we did get some lows below here in terms of intraday low, but on a closing basis, it did close well above that particular 38% level. And traders, that takes us to our current market rally. To do that, I've simply taken the very same chart and I have moved it from a weekly to a daily. We are now looking at this last rally, and of course this last rally took us from 1308 to our record top at 1577, 1578, depending on if you're looking at the bid or ask in the market. These charts that I typically look at are the lower of those two prices. We can see quite clearly that when this market came down, this is our A wave here. As this market came down, it found definitive support at our 38% retracement level. Now, you can see on a intraday basis, because this is a daily chart, that we did get lows below that, but on a closing basis, it closed right at that point. It then traded back up, and when we look at the Fibonacci retracement from that point, it falls exactly in line. And the way that we'll simply do that is draw a Fibonacci retracement from here to here. And as I said, the most critical level really is that mark between the 50% level, of course, and the 75% level. And we know that it touched just above that 50% level, as you can see right here, by looking at this Fibonacci retracement area. And of course, this is a simple Fibonacci retracement from this high at 1577 down to 1462, that being the low. And you can see that we found superlative resistance right in this area. So the question will remain, if the market wants to continue to correct to a flat correction or a truncated correction, this is the area that it could correct to. But I do not believe it can correct to any more than that. And I also believe that we are witnessing a marketplace that is exhibiting techniques of a simple correction, nothing more, nothing less. In other words, it is still my sentiment at this point that what we are looking at is a correction and not a fundamental shift from being in a bull market to a bear market. I believe that we are in a bull market correction. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for another daily review and update. Bye-bye.
Many sights to see, and when I look in my window, so many different people to be. that it's strange